So welcome and welcome to our women's series. We're continuing on that theme based on topics that people have been reaching out to us. So we added insurance in as an additional topic. So we're going to talk today insurance strip bare, what you really need to protect your assets. Now, insurance is one of those I like to say that necessary evil. None of us like to actually pay for it, but when we need insurance, we're really thankful that we've got it in place. So just a few little things, a bit of important information just to go through. Obviously, all of this that we're going through today is general advice. It's not specific to your circumstances. So just all the fine print that we need to raise as well. Now, just to go through your presenters today, myself, Shannon Smith. I'm a financial advisor. I've been specialising in financial advice for a number of years, an accountant by background as well, and have a lot of experience in these types of areas. I did win Financial Advisor of the Year in 2021. Presenting with me today is Bianca Carroll. She's a provisional financial advisor, also a winner a number of 2 years ago as well, and she will be going through all of the insurance today. So I'll hand you, I'll go through the agenda so we can just go on. Now on the agenda today, what we want to go through are what are the types of personal insurance? What are we talking about when we talk about the different types of insurance? What's the insurance cover that you may need at different life stages? And that's one thing about insurance, is that it's not a take out the insurance policy, a set and forget type of situation. How much insurance do you need? And what are stepped versus level premiums? I note that a lot of advisors don't go through this with their clients to really help empower them as to what the choice might be. Is insurance tax deductible? Some are, some aren't. So we'll go through that. The ins and outs of business insurance. So for those of you that run a business, I'll go through the business insurance aspects and how it's important that you consider that when it links into your personal insurance situation. And then we'll go through how an advisor can help when we're going through all of this. So I'd like to pass you on to Bianca, who will be running through today's session.
Thank you, Shannon. Very excited about today's session. Insurance planning is very close to my heart. I really enjoy being able to place clients with the insurance that's suitable for them and their needs and what they're needing. So looking after what matters most. So one of the first things we do when we buy a home is insure it. One of the first things we do when we buy a car is to insure it. So how do we look after our home and our car? We work. So when you've created a comfortable lifestyle for yourself and your loved ones, it's worth thinking about what would happen if you were unable to work for a while because of an illness or injury. How would you and your family cope financially? Not only with the costs of medical care, but also keeping up with the expenses such as mortgage payments, bills, and school fees. Insurance is an important way of ensuring that your family and your business will always be looked after, no matter what happens. It provides you with a financial safety net to support you and your loved ones if the unexpected occurs. And the way it works is like this. You pay a premium on a regular basis, and you or your beneficiaries receive a payout after an event like an illness, an accident, or death. So the money you put into your insurance cover is working to protect the things that matter most to you. So your family, your health, your income, your business, and your lifestyle. Some people do see insurance just as an extra cost they can do without. So let's look at some of the statistics. When you're young and healthy, it's not pleasant to think about how you might change in the future, how your world might change, but the reality is that accidents and illnesses can happen to anyone, and even a less serious diagnosis can have a major long-term impact on your finances and your family if it puts you out of work for a while. And that's why it's best to be financially prepared. And the odds may actually be higher than you think. So in Australia, 50% of us will face a cancer diagnosis by the age of 85, and that's for both men and women. 1 in 5 people are living with some form of disability, whether temporary or permanent. And in a single year, over 1 million Australians are diagnosed with heart disease, which is the leading cause of death nationally. So without being an alarmist, it's important to understand that these aren't just things that happen to other people, and that's why insurance matters. So however, but despite these risks, Australians continue to be massively underinsured, with many families not having enough cover to take care of their financial need if something does go wrong. So in fact, the amount of life insurance held by Australians on average is 143,000, when the estimated need for a young family is $700,000. By comparison, if you're getting life insurance through super, like 70% of Australians, the typical cover is just $200,000. Only 1 in 3 Australians have income protection insurance, which means they could be left struggling financially if the household breadwinner is unable to work due to sickness or injury. The end result is that if a death, illness, or accident affected your family, you may have to rely on Centrelink benefits, dig into your savings, or perhaps even sell your home or investments. So it's not enough to just have insurance. You need to make sure that you have the right level of insurance. While most people have insurance for their home and cars, they pay less attention to personal insurance. So even though these cover things that have the greatest impact on us, life, ability to earn an income, lifestyle, there are 4 main types of personal insurance. We'll review those today for you. We have life insurance, total and permanent disability insurance, which is also known as TPD insurance, income protection insurance, and trauma insurance. So for an overview of life insurance, so life insurance pays you a lump sum if you to your beneficiaries if you were to pass away. It also pays you a lump sum if you were diagnosed with a terminal illness. And your loved ones can choose how they wish to spend this money, whether it be paying off debts, covering funeral costs, or investing in their future. Total and permanent disability insurance, or we refer to it as TPD insurance, provides a lump sum benefit if you're permanently unable to work due to serious illness or injury, which may be physical or mental, helping you to cover the costs of medical care, any renovations that may be needed, and ongoing living expenses. Trauma insurance pays a lump sum benefit if you're diagnosed with a specific major medical condition. So each trauma policy is different. Most trauma policies cover around 40 different types of serious illnesses or injury, which can include cancer, stroke, heart attack. And you can choose how to spend this money if you claim. So it can be used on medical expenses, rehabilitation, or alterations you may need to your home, or anything that your family may need. You can even include child trauma cover to your trauma insurance policy to have your children covered if they were to suffer a serious injury or illness as well. Income protection insurance. So this provides regular monthly payments if you're unable to work because of an illness or injury. And this monthly benefit can be up to 70% of your income, enabling you to support your family by covering the basic living expenses, mortgage repayments. The premiums for income protection insurance are also tax deductible, and the benefits are taxed at marginal rates the same as your income. So as you move from one stage of life to the next, you face different types of risks, which means that the types of cover that you have and needs can change. So in the early years of your adult life, you're just starting out in your career, and you have fewer financial commitments. Because you're in good health, your need for life, TPD, and trauma insurance may be lower. And however, with the income protection in place, you could be confident of maintaining the lifestyle that you enjoy and putting aside savings for the future. In the next stage of life, you might get married, have children, buy a home. You're probably juggling your work commitments with the financial responsibilities of supporting your family and paying off a mortgage. So this means that your need for income protection, life and TPD insurance, trauma insurance cover, they're all very high, as you want your loved ones to be fully protected in case something happens to you. As you move through and after your children leave home, the financial squeeze eases. You may be focused on growing your wealth and paying off your mortgage so you can enter retirement debt-free. However, as you approach retirement age, your health risks increase, making personal insurance cover necessary, since any period of time that you take off work can make a significant difference to your retirement savings. And once you retire, and no longer have an income to protect, your financial focus may shift to preserving your wealth to fund your retirement. So with the potential for increasing medical needs, it makes sense to maximise your life, TPD and trauma cover as maintaining your health becomes your priority. How much insurance cover do you need? This is an all-important question many Australians struggle with to answer when they're looking to protect their family's financial future. Putting a price on your life is no easy task, and the reality is that with the right amount of insurance, it varies depending on your personal circumstances and the state of your finances. So some considerations when assessing what you need your insurance to cover could be, would you like your liabilities cleared if something were to happen to you? Would you like insurance to cover any future expenses such as your children's education or household living costs? Would you like medical costs covered? Would you like insurance costs covered? Some considerations when assessing what you have. Do you have assets that you or your family could sell if something were to happen to you and you were unable to earn an income? If you were unable to work, would your household still receive an income from your business or from your investments if you have those? And do you have superannuation? So under certain events, your superannuation can be used as a disposable asset. To determine an appropriate amount of cover that you will need to look at to have your debts covered, that your family would still need to pay in the event of you being unable to work or pass away. Each year, families are left devastated not only by the loss of a loved one, but by the debt that they must cover following their loved one's passing. This can be a really stressful time on a family. So to determine an appropriate amount of cover, you need to take into account any debts that you currently have owing, and these could be your mortgage. So this is not restricted to your family home. Could also have investment properties with mortgages, holiday homes with mortgages. You need to take into consideration all of your mortgage debt. Any outstanding loans, so this may include personal loans, investment loans, business loans, car loans. These all need to be taken into consideration. And also another one is any existing credit products. So if you have any money owing on credit cards, interest-free transactions, store cards, things like that. And so these are different for every individual. So personal insurance will depend on your current situation. Insurance planning through Smart Business Solutions Financial Planning includes working with you personally to provide you with a comprehensive plan for your personal insurance needs. So we work with insurance providers that have underwriting process at the beginning and pay out claims so that you're not surprised when it comes to claim time, as the insurer already knows your health up front. So this can be the difference between personal insurance planning and applying for insurance over a 2-minute phone call. So we work with you to ensure that your insurance needs are balanced out with affordable insurance premiums suited to you and your needs. And some of the future expenditure that may be considered when putting in place insurance for you and your family are annual living costs. So this includes your food, clothing, bills, taxes, petrol, education costs for your children, whether it be private or public school, children's sports, extracurricular activities, other planned expenditure, so annual holidays, renovations, any future investments. Also taking into considerations any investments that you may have, so considering property, other investments that you currently have. Would you want your surviving family members to maintain these if you were to pass away? Homemaker duties, this is often a good one to consider as well. So if you weren't there anymore, what are the cost of the unpaid duties that you currently do with your housekeeping, home maintenance, gardening, looking after your children? If you're not there, then someone may need to be paid to do those things, and that needs to be taken in as a consideration of a future expenditure that you could cover under your insurance. Continuing income. So do you have any annual leave or long service leave build up? Do you have incomes from investments or a business? Do you have other insurance policies in place that you're able to claim on if you needed to? For example, if you have did have to happen to claim on an insurance a trauma insurance policy for a health reason, for example, cancer, and you were unable to work, you could also claim on your income protection insurance. So you could have a claim from each type of policy. It's not just necessarily claiming on only one policy that you hold. So we need to take into consideration all the policies that you hold. So when looking at disposable assets, do you have any current savings? Your family home, would your family be able to stay in your family home? Would they need to sell it? Would they need to downsize it? Do you have investment properties? Would your family want to keep the investment properties, or would they be happy to sell those if you weren't around or if you weren't working anymore? And also any other investments like shares is also something to consider. So what are stepped and level premiums? So stepped and level premiums are insurance premium structures, and life insurers will generally offer you the choice to have either stepped or level premiums, sometimes a combination of these. So the type of insurance premium structure you choose will affect the initial cost as well as the total cover over the life of the policy. So you have a choice when it comes to paying insurance premiums, stepped or level, but what does that mean and which one is right for you? There is no one size fits all answer, as both policies will be suitable for different types of policyholders. So we aim to lay out both the benefits and drawbacks to stepped and level insurance premiums that proves the question is not complicated. In fact, it offers people greater choice in protecting their loved ones. So we can use this as a guide to make a more informed decision about what option is the best fit for your unique lifestyle, needs, circumstances for now and for into the future. Stepped premiums. So as the name suggests, stepped premiums start off at a cheaper point and rise from there like steps. Premiums are recalculated each year as you get older. And with stepped premiums, you can save money in the short term while resting safely in the knowledge that your loved ones are protected. So one drawback to a stepped insurance premium is the inability to accurately predict and properly plan for the increasing premiums. Policyholders with stepped premiums will need to look ahead and think about whether they have the funds for the higher premiums as they enter their 50s and 60s as well. So to look at level premiums, initially the cost of a level premium is more than a stepped premium, and they do increase each year with indexation of CPI. So while premiums are higher in the earlier years with the level premiums, they're more likely to remain affordable in the long term. So depending on how long you hold the insurance cover for, and as long as you can afford them, level premiums can save you money in the long term. So what's right for you? Generally, level premiums do not stack up until after the 10-year mark. So if you intend to have a type of insurance for a long period of time, level premiums may be a good option, depending on how long you want to have the cover. So time is an important element to consider when buying life insurance, as the time frame you opt for will directly affect the costs of your policy. And since stepped premiums increase with age, it may not be such a suitable option if you were looking for long-term cover. However, if you're thinking less than 10 years to have insurance in place to be there to pay off some loans while your children are going through school, you have a bigger mortgage, then stepped premiums are definitely an option to consider. If you're thinking about building your estate and leaving an inheritance for your family, then level premiums may be your chosen choice, as they can save you a lot of money in the long term. Another thing to consider is, do you have the right investments to eventually self-insure? So insurance can be like a Band-Aid, so it's there to protect you and then it's taken off when you don't need it anymore. So it puts you back into the position that you were in, and that's what insurance is for. So do you want to keep the same level of cover? You can put insurance in place and you can modify that as time goes on. You don't necessarily need to put insurance in place and leave it there forever. So you can plan to increase or decrease your cover as you go through your life stages. So if you think about the cover that you have right now, or that you intend to put in place now, think about whether you would want to have that cover for short-term or long-term, and that may help with choosing the right stepped or level premiums. Do you have children? So when you're a parent, children play a big role in your decision making. You don't consider just yourself or your spouse anymore, but the young lives under your care as well. So children can eat up a lot of income, literally eat. This scenario can lead to anyone shying away from getting life insurance. You know, it's just another cost. But, you know, instead of abandoning the idea of having insurance, you know, a stepped premium may be the answer of having insurance in place for a short term to have a low initial premiums. And then when you're more free from your financial obligations in the future, then you could increase or decrease your cover accordingly to your situation. So what are the key differences? So stepped premiums, they're like a variable mortgage rate, whereas level premiums are like a fixed mortgage rate. Stepped premiums are calculated each year and increase each year on the policy anniversary, whereas the level premiums increase slightly each year with CPI. The stepped premiums will increase significantly once you reach about age 50 and over, whereas the level premiums at that point would be more affordable. Is insurance tax deductible? This is a great question. So life insurance held in your personal name is not tax deductible. Life insurance held in your super fund is tax deductible to your super fund. TPD, or total and permanent disability insurance, is not tax deductible in your personal name, but it is tax deductible in your super fund. Trauma insurance, unfortunately, is not tax deductible in either scenario. And income protection is tax deductible in your personal name at your personal tax rate. And income protection insurance is also tax deductible to your super fund. So there are some benefits in holding insurance policies as well. So now I'd like to pass you over to Shannon, and Shannon's going to go through our business risk insurance. So another great topic to go through. Thank you, Shannon.
Thanks for that, Bianca. And yeah, great. It's an interesting topic. I'm sure not everyone's as interested as we are in insurance, but as Bianca's gone through on the personal side, there's a lot of different variables that really can help you get to the most, optimal product that's going to be the best outcome for you. When you've got a business, if you are running a business, it's really important to consider some of the business risk insurance. Now, when we talk about some of these types of insurances, the business insurance, there are various types that we're covering under our type of insurance area. You do have your general insurance. Now, your general insurance from a business perspective might be PI insurance. It might be, any of those other types, loss of, if the factory stops working, if you have a power failure in the factory or something like that, there may be those types of insurances. The insurances we're looking at are those aligned with, I guess, what we call the personal insurances side of things. So looking at protecting, what if you've got a key person in your business? If something happened to that key person, doesn't have to be the business owner, could be often more than not, it is the business owner. But if it wasn't the business owner, what would you do then? What would you do in a situation of, major revenue drop in the business as a result of, something happening to this key person? How would you repay debts? How do you protect the assets from creditors? And how do you fund a business succession agreement? If you've got two people in a business and something happens to one, what do you do then? So the four types of business insurances that we have that we're looking at is looking at the buy-sell insurance, key person, or what we call capital insurance, so key person capital insurance, key person revenue insurance, and then business expenses insurance. So I'll go through each of those. So if we look at the buy-sell insurance, so buy-sell insurance is basically protecting a situation where you may have two independent owners owning a business. Something happens to one of them. You can do this under your life, TPD, and the different insurances, but something happens to one of them. What happens in that situation? What is the succession? So it could cover the death of a partner, TPD, a trauma or heart attack. And what it means is it enables the remaining owners to actually have to basically buy the business from the person that has actually suffered this situation if they're no longer going to be involved. Now, that'll also come down to what you would have as your kind of shareholder agreement with the person that's actually that you're in business with, but you'll have a predetermined agreed price that will come up, and it will be based on the valuation of potential of the business at that point. And what it does is it enables a smooth transfer of the interest in the business, and then funding available to enable the transfer. Now, if I give you a real example, so two business owners running a particular business, one of them was actually diagnosed with cancer and subsequently did pass away about 2 years later. Now, this particular business, we'll call it a company, was owned by, in a sense, two family trusts, but two different families. Upon the passing of this person, they owned half of the business. The issue that it would have caused for the business partner that owned the other half of the business, if they didn't have the funding to pay out the owner that has passed away, or the family of the owner that has passed away. So what do they do if they don't have the ability to get the funding to pay them out? On the flip side, the family that obviously is going through quite a lot with having someone pass away, what if that person doesn't have the funding, or what if there is no buyer and in a sense they don't have the funding, they can't sell it, and all of a sudden half the business is just gone in a sense, and they're not getting any funds. So having a buy sell in place, there's an agreement that goes with it with the insurance, means that in this particular situation, and they did have buy sell insurance in this particular situation, it meant the family of the person that had passed away received 50% of the value of the business in dollars, in a sense, paid to them by the insurance company. And the business partner, the other business partner, the surviving business partner, actually received the ownership of the business owner that had passed away's shares. So the insurance company was the one that actually funded that situation. So that's the buy-sell arrangement, so that if there's one of these situations, and whenever you've got more than one independent party in a business, I highly recommend these buy-sell arrangements to be in place. So if I move on to the key person capital, so this is where we identify that we have a key person in the business, that losing that key person, whether it be in a life incident, TPD, or even trauma, losing that key person causes the revenue to go down significantly, business costs to go up because maybe you've got to hire someone else to actually replace that person. So this key person insurance the proceeds can be used for that. Now, there's two types of key person. There's key person revenue and key person capital. Key person capital is basically to help replace the revenue that the key person would have generated to pay out the debt or funding that the company may have. So that's the capital part. So that we would often look, when we're looking at that, is what is the debt that the business has? And that will often be what we're looking to cover when we have key person capital, so that if something was to happen, the debt is paid out of the business and that part's covered. So if I move on to the key person revenue, what the key person revenue does is actually replaces the revenue side. Now, it could be that it replaces the revenue side and the business uses part of that money maybe to pay debt, but also mainly business expenses, and to find a suitable person that's going to replace. So when we're doing the calculations on what's the level of cover we need, we look at, if that person was no longer working in the business, how long would it take, what kind of hit would we have to the business? How long would that hit for the business be, that decreased revenue, so that we can kind of use the insurance as that, as Bianca talked about before, that Band-Aid to help the business through this particular period as well. And then the last type of business insurance that we focus on is business expenses. So this is very important if there's a situation where the business has got quite a lot of expenses, and that the business owners are largely responsible for generating the business cash flow. So that if there was something to happen to them, the business expenses keep going on, and it would significantly, and so this kind of comes as that band-aid in that particular situation. So the business expenses, that can also be, I often like to say that the business expenses insurance is a bit like the business version of a kind of income protection. When you can't work and you've still got bills, it gives a bit of the band-aid on those particular expenses. So we cost out what that might be, and you can cover that also for smaller amounts that you might not see on the key person insurance. So what you've probably seen with all of this, and how a financial advisor can really help in trying to get the right insurance, and as Bianca talked about, the different life stages that you go through, is making sure that you adapt your insurance. It's not about always going out and getting another insurance policy. It's actually just about being able to adapt and tailor it so that you do really have a tailored insurance strategy. Now, I know no one's going to love insurance as much as us, and that's okay, but it's really important to have this type of strategy so that you're not overpaying premiums, you're not overinsured, but you're also not underinsured. And I think that, I know when I first went into insurance, I always thought of it being, it's kind of one of those necessary evils a bit, but it was this big cost. And the more working with clients that are having to get payouts, the more relevant I see the importance of the insurance. So it's really working out, when we look at insurance, maybe you would love the insurance company to cover this level of income, but the cost is also at this level. So we often work with clients to kind of balance it and go cost benefit, because insurance, you want the maximum amount of cover, but it also needs to be affordable to you. And so we're often looking with clients on how we can balance those two out. I mean, I know the biggest thing that I wish, and I'll have this for my kids, and we actually have worked with quite a number of our clients, adult children. I wish at, age 23 to 25, when I was as healthy as anything, that someone recommended me to go and get life insurance on a level premium at about $1 million. And that's what we've been working with those young adults at that age. You get that, and the premiums that you get when you're getting to the, age 50, someone will be thankful for us in years to come. They'll be thankful that we encourage them to get it in place at that point in time, because it's one of those things that none of us really think about a lot of this until we get older and things start to get a bit more expensive. Some of the other areas we can help you with, at Smart, we do try and be that nearly one-stop shop, just to kind of make it really easy for our clients. We can help you with tax and business advisory. We do a lot of business coaching, financial planning, mortgage broking, equipment finance, wills, power of attorney, software implementation, bookkeeping, asset protection, and then obviously the insurance. So we try and have this full service. There's always other services I'm thinking of adding, but really just to help that we've got a lot of your personal data, and if we can help save you time by, for example, if we work with clients on tax and advisory and financial planning, to get them a loan, it's so much easier for clients that we don't have to ask them for too much data, because we've got pretty much a lot of their information as well. Now, I'll just check. It doesn't look like we've actually had any questions come through at this point. I think we've probably covered it quite a lot there, Bianca. Now, if anyone has any questions, if anyone has, no, we don't have any. Okay. So the Women's Series, the next one we're going to be looking at all about estate planning. Another one of those topics that none of us really want to talk about, but really important to have peace of mind with, basically the end in mind. So we'll go through on the estate planning, some of the practical areas like that. And if there's any other topics that you would like us to cover, today's session was one that we were asked to add. The estate planning is one we were asked to add. So we're happy to add any other topics that are relevant and keep our Women's Series expanding. We do have some other videos, like today is being recorded. We've actually recorded a lot of our webinars and some of our short snip videos, especially a lot around SMSF, investing in property in SMSF, if you're interested in those areas. So do go and like and subscribe on our YouTube channel, and you'll keep updated with all of those. But thanks very much, everyone, for joining us today. Thanks, Bianca, for going through that.
Thank you, Shannon. Thank you, everyone.
Hope to, feel free to reach out if we can help you with anything in relation to your insurances or any other aspects on your financial matters, and we're happy to help you out. Thanks very much.